coming to you here on Thursday, March 20th, 2025. I want to take a few minutes and just review the current market conditions and why we are in a position where we're not going to get a bounce. And if you're not doing this in your trading, you're really missing out. This is the time you to follow this specific strategy. So hang tight while I get over there and show you that. So anyway, things are really getting jumbled up here in the market after FOMC here. So hang tight, I'll get over there and show you the details. All right. So here's a kind of a picture of the SPY here. You can see the dramatic drop that we've had. I guess you want to say starting on 220. This is obviously part of this mention to tariffs. The reaction, it's been definitely pretty negative event. Like we came down into a correction area pretty darn fast. You typically ebb and flow down. We came down at a very distorted angle. That's important to note because these type of bounces often end up being dead cat. And we don't get that type of bounce that you see. We came down, we tried to hold the 200 in the red here, down to pivot support, and then I went down and put second level support pivot at 557. We've taken that out, we've bounced, we've retried almost on a shorter time frame. This would be an inverted head and shoulder. The issue, though, is that now we're trying to basically get up at least to this 200. We can't even manage that. This is FOMC right here, this day here yesterday. Here's today. Although we gapped down most of what Powell had said to move the market up yesterday, we certainly wasted no time before we were trying to get higher and came pretty darn close to where the high was on FOMC day on Wednesday. But no bueno, this thing just continued to fall down. The market has no staying power. People are not bouncing. The market is not bouncing and sticking in here. So to my previous question, what should you be doing in an environment like this? This, in my opinion, is where you need to live in the scout mode. Not about trends. You're not going to find trends that stick, right? Any trend flow going forward, trend lines, there's going to be always a few. Most of them are not going to be able to handle or weather this storm here. That relative strength, if in fact they do have it, is going to wear thin when the market's just trying to bounce off these bottoms in here. So the strategy that I'd use going forward would be looking at these daily charts, maybe the 65-minute chart, looking at certain stocks, high catalyst stocks, high market cap stocks, and just basically playing off the bottom. Now, for me, what I use is a strategy of support resistance, as a lot of people do. But the thing that I'm doing, I'm not looking at first level support. First level support is easily taken out in these areas. I'm always looking down to second and third level support. If you don't have that, you can go to bar chart for free and look under the trader's cheat sheet. It'll give you these support levels. And this is actually one of them right here I have on TC2000. So the market's second level support's 557 and change right here at the red line. Now, I suspect that we may attempt to go higher still in the coming days, but we're going to probably result back down to this trend line and maybe even take out the bottom before we make that bounce. Now, this is too early to tell, but in general, what you're looking for and why I said you have to employ this at this time, these type bounces almost never V-bottom. Heck, they won't even get up to 38.2 on a Fibonacci level, which I'll draw in a second. These will chum around, right? There's umpteen billions and potentially trillions of dollars that drop this market at that angle. They do not move back up at when you think that they should, right? You can scoop the bottom. You can leg into positions. Give them wider stops, less shares or less contracts if you're going out on leaps or longer dated options, and add to and raise that stop risk. That's how I would do this right now. Tight stops, unless you're going to be out in 1 to 2 days, are not going to work in this environment. Very difficult to get that. So stay scalpy in that sense and go longer out in time and go far less in your contracts and shares and begin to nibble back and then cost that average in as the market does. Another good rule of thumb is when the market drops or moves up at this level, what you typically see on average, you want to see a consolidation or a whip bounce for at least the length of the drop. If I took the length of the drop and I turned it sideways, that's about the level of consolidation that you'll want to see. At that point, the market will have run through a lot of the issues and then maybe begin to work back up. People looking for that bounce now outside of an intraday bounce, they're just not going to get it. If it does, it would be out of the ordinary for sure. Let me take a look at the Fibonacci levels from that original top on the 19th. You can see here, we are struggling to even hit the basic one, 23.6 is almost dead cat, right? Your 38.2 is still a negative bounce in a downtrend. We can't even make that. And it's positioned right above the 200 period moving average in here. We're struggling to hang in there. We may crest up a little bit, but you can count on this market unless something significant comes out news-wise that totally changes the immediate trajectory. We're going to bobble back and forth, maybe grind higher a little bit, maybe grind lower, but we need to wear off some of this distance. Like I said, that length of a drop in here needs to be sorted with some consolidation to help heal that drop. The other way to look at this is, if this were a 10-story building and you fell out of that 10-story building over time or one drop in one day, the reality is that you will not get up right away, right? So just like in that theme, it's the same with the markets. When they get hurt and hit this bad, they don't forget all that. And even if they did, understand there's umpteen hundreds and hundreds and hundreds of billions of dollars that were sold off in here. It doesn't correct that quick. So keep that in mind when you're thinking about this. So I guess my advice would be stay scalpy, maybe 1 to 2 days out if you want to do something, maybe moderate swing, but try to scalp the bottom on pullbacks, go less contracts, go less shares, scalp these bottoms until the market settles back here and you can get a little bit more broad attraction. Again, if you're going wider stops and you're using a risk management system that you can calculate your shares or contracts based on the risk, where the stop is, do it smaller and wider. Allow yourself to core in. Almost when you're nibbling down position, it's the same process, allowing this to stabilize, and that way you're not taken out in one fell swoop and losing that amount of money. You're letting it do its thing. So if you're risking $500, you may want to come in at $75 and give yourself some time to add to these little ebb and flows and the drops. That way it's less painful. You don't have something coming against you. You don't have a gap against you. You're worried what's going to happen. You're dealing with it as it comes. You almost welcome a little bit more of a pullback to add at a better price. So hope that helps. This is Jeff Yates at Full Throttle Traders. We'll see you in the next trading day.